Hello everyone, welcome back to another video. So this is the part 2 of the private company valuation mistakes video series. And so if you haven't already, I would recommend that you watch part 1. And if you haven't watched the private company how-to valuation series, that'd be the other one that I'd recommend you watch. And there's another 2 parts there where I go through the specifics of how to determine the sustainable EBITDA, looking at the EBITDA multiples and how, multiples are impacted by both qualitative and quantitative reasonings. But really, at a high level, most companies in the lower mid-market and small business space are valued on a multiple of EBITDA or adjusted earnings, sometimes revenue, but in most instances, EBITDA. And so, that in itself is almost a generalization because, in each specific instance, based on the company and the type of business and the type of working capital requirements, there are other variables that influence the true net value of that business beyond just the EBITDA multiple. And so in this part 2 video series, I'm going to be focusing more on the balance sheet side of valuation and some of the things that buyers and sellers overlook. Now, in part 1, we really focus more on the cash flow side, really determining the sustainable EBITDA and dealing with situations where maybe there was a ramp up in the last 1 or 2 years in earnings and how to justify or structure that deal and price that deal. And then on the flip side, maybe there's a situation where a business is about to hit it big, get some major contracts and ramp up. And so there's the hockey stick situation where today they're small, but they're going to be significantly larger, and how to value and price a business like that. And in both of those instances, it's really about thinking what's sustainable, what can be demonstrated, and then as well, what type of terms is a seller willing to accept? Because terms is going to dictate the ultimate value of those businesses. Because if the seller is willing to share in the risk, accept an earnout, accept some seller financing, they're going to get a higher valuation. Conversely, if they're only willing to take cash and they're not willing to share in that risk, then buyers are going to be more hesitant to pay for future profit in a hockey stick situation, or to pay for one-time profit that's only been seen in the last 1 or 2 years. So I always say with private company valuation, there's no right or wrong way. And in general, it's not a single price. You can't just say, oh, that's a $2 million business. Well, no. It could be a $2 million business. It could be a 2.5, or it could be a $1.5 million business, depending on the purchasers and sellers' terms. If the seller is more favorable in terms of the terms they're willing to offer, then you could probably get a little bit more. On the flip side, if the seller is looking for a quick exit, all cash, you're probably looking at a lower end of that valuation. So really, private company valuation is actually a range rather than a specific number. And so in this video, these are the 4 mistakes that we're going to be focusing on. Understanding the concept of net working capital and excess and deficit net working capital in certain types of situations. We'll be talking about 2 examples. Understanding the assumption of cash-free, debt-free, and where it's not relevant, because in certain instances, it's not appropriate to say it's a cash-free, debt-free closing. Also understanding the difference between book value and enterprise value and how to factor into that when it comes to valuation. And then the last one's really focused on, in this, I've seen this very often, is ignoring the impact of market rents, especially in a situation where commercial rents are increasing in the general marketplace. So let's focus on number 1, and let's first talk about the concept of net working capital. So whenever you sell a business, the assumption is that I'm buying X amount of EBITDA, a sustainable level of $1 million. And so to deliver that $1 million in ongoing EBITDA, I need to fund my monthly operating expenses. And so that means that there needs to be an inflow of cash coming in week 2, week 3, week 4, whenever payroll hits. Because if it's going to be a cash-free, debt-free closing, I need to have some other sort of net working capital that's going to be able to help me fund my operating expenses. And so really, net working capital in most instances is cash-free, debt-free, even though mistake number 5 is going to talk about that anyways. But, it's AR plus inventory plus prepaid expenses minus accounts payable and accrued liabilities and any other kind of current assets or current liabilities. But it's essentially current assets minus current liabilities equals net working capital. And so, the reason why you want to leave that net working capital behind is you don't want the buyer to wake up, week number 2, they don't have any net working capital and they have to put more money in to meet payroll. Because if they don't put that money in, then you're not really buying a $1 million EBITDA business. You're buying a shell of a company because people are going to quit because they're not getting paid, right? So the assumption is you're going to deliver that working capital to them to allow them to continue running that business. And if you deliver less working capital, well, then they're going to have to put money into the business, whether it's month 1, month 2, or month 3. But really, that additional investment required to sustain the current level of EBITDA is actually an acquisition cost to the buyer. And so it's unfair to them to pay you full value and then also put more money into the deal. They're looking to put money into a deal and pay full value, and that's it, not put any more money afterwards. So if they have to, and if you get tricky or sneaky with the net working capital, what ends up happening is that buyers simply lower the valuation of your business, knowing that you're a little bit more aggressive in your working capital ask, versus you just deliver normal level working capital and you'll get full value for the business, right? So here on the right is a snippet of a real life LOI that reflects kind of these terms, and you can pause the video and read through it all. But just at high level, the first paragraph defines net working capital as we defined it up here, which is, current assets minus current liabilities as defined by Canadian GAAP, the accounting standard. And they actually spell out the actual accounts that are included for this specific deal: inventory, prepaid expenses. This company had deferred revenue, accounts payable, accrued liabilities, and that, as I said, but shall exclude cash, income taxes, and related party receivables and payables. Then in this second little paragraph here, they define target net working capital. And so target net working capital is essentially the target or the normal level of working capital that should come with the business. So it's an actual number that's calculated. And in this instance, they said it's based on the normalized trailing 12-month average of net working capital the last 12 months of balance sheets. And so that actual number is what's used as a target. And so this is the key point here. The purchase price will be adjusted upwards if the final net working capital figure on closing is higher than the target net working capital, and vice versa. If the net working capital on closing, when they actually close the deal, is lower than the target, then the purchase price gets adjusted downwards to reflect that the buyer's now going to have to factor in a higher acquisition cost to normalize their working capital. And so that purchase price adjustment is how in most deals, net working capital gets accounted for. So now let's actually talk about it, because the thing here is this is net working capital. And the concept, when you value a business, you don't only just look at EBITDA and the multiple, but you also need to look at that balance sheet and understand, hey, is there an excess net working capital or a deficit net working capital situation to really confirm whether the purchase price is going to get adjusted up or down when a deal actually sells. And so think about this, whenever you're looking at valuing a business, the key questions that I ask is, number one, have there been any changes in net working capital over the last 3 years? So I would look at the last 3 years of balance sheets, calculate the net working capital, and say, based on a percentage of sales, so net working capital divided by annual sales, is it 15, 16, 17%? Is it kind of steadily increasing, or is it flat? Is it all around 15%? Or is it volatile? Is it 15%, 27%, 3%? Why did it change, right? And you really want to zero in and spend more time thinking about this if there are changes. It could also be the same, and usually this is why the net working capital changes. The payment terms for AR or AP are longer or get extended, or the cash conversion cycle changes. You really want to zero in and start focusing more on that if these things start happening. And then the other one is, and this is more relevant in a COVID, kind of global supply chain environment, is that maybe the business has changed their inventory purchasing strategy. So I specifically ask business owners, hey, have you changed the way you buy or stock inventory in the last 2 years? Explain that to me. And, with those, reasonings and kind of the story behind those changes, you'll be able to better understand if there's an excess or deficit situation that you need to consider when you're valuing that business. So you can think through it this way, for high net working capital businesses like a distribution, retail, high volume manufacturing, where you have, stocked inventory that you have to distribute or raw materials that you have to process to manufacture things, the real focus is on ensuring that you have a sufficient level of raw material or inventory to support the level of sales, and that any AR is not any bad debt risk, and as well that the inventory is usable, that it's not obsolete and should be written off. And then for working capital light businesses, such as, a consulting company, an HVAC business, something like that, a lot of the working capital is more focused on, just enough to cover the operating expense over the next 3 months, because realistically, there's very little working capital. You just need to kind of get through one of the payment cycles. And I would say it's typically 3 to 4 months where that focus is. But, I'll give you an example right here. So for certain businesses, the focus is on understanding even the difference between accounts receivable. There's accounts receivable that are progress payments, right? I make a progress draw, I charge a customer on a monthly basis for work that I do, but there could also be project related holdbacks. And so in those instances, you can even carve it out further. If the business has holdbacks, in most instances, you can justify that those holdbacks should go back to the seller, because those holdbacks are for jobs that have been completed 2 years ago or 1 year ago. The costs are fully incurred on that job, and that's really the profit on that job that they're finally collecting on. And so it's not really relevant for the current level of earnings and the current operations and the current OPEX. That's really just the profit from past jobs that have been completed. So for most construction companies, contractors that we sell, if there are holdbacks, we actually carve that out, and we already factor that into the valuation. We do the EBITDA multiple, and then we ask, what's your holdbacks on the balance sheet? And they'll give us a $800,000 figure, and we'll say, we'll probably get that $800,000 for you as well, because that's your money that you're waiting to collect on. So, just to understand, that's probably a really good example of excess value on the balance sheet that sometimes people just don't account for. So now let's look into 2 examples. So in the first one here, this is a distribution business, and COVID environment, obviously. So they were impacted by the supply chain instability in North America as well in Asia. And so what ended up happening is that they were buying a lot of inventory from overseas. COVID hit, there was a lot of challenges with the supply chain getting product on time. So naturally, to mitigate the risk of not having stock, they increased the level of stock that they carried. And so, back in December 2019, pre this global pandemic, the business did 10 million in revenues and carried about 1.6 million in net working capital. Now, in the current environment, they're doing 9.6 in sales, which is very close to kind of that 10.5, but they're carrying 2.75 million in net working capital, so significantly higher. And you can see the monthly balance sheets ramping up, even though sales is actually almost steadily coming down. So in this situation, similar sales level, but they have almost $1 million more of cash invested in net working capital to support the business. So the question in this situation is, what is the normal level of required working capital for the business? Because the global environment is what it is today, they've made this decision to invest more money into the business. But is this a one-time situation that should probably be normalized? Probably yes. And that's in this deal, when we sold this company, that was the story, and that's how we positioned the company to say, listen, at the end of the day, this will pass when it will pass, whether it's 6 months now from now, 12 months, 2 years, or 3 years from now, but it will eventually normalize to where you're buying a 10 million sales business. Realistically, that in a normal environment will require about 1.6, 1.7 in net working capital. So the excess amount should be accounted for via a purchase price adjustment once things normalize. And so the way we got this deal done is actually we structured it as a holdback. It was a term of 2.5 years. And so after 2.5 years, essentially both the buyer and the seller agreed, hey, within 2.5 years, things should settle down and we should probably be in a much more normal environment where you don't have to double your lead times on supply purchases. And, once those 2.5 years go past, I'm comfortable in releasing the holdback to allow you to kind of recoup the additional $1 million in invested money into that balance sheet. So in the situation when we were pricing the deal, we zeroed in on this and said, hey, there's this ramp up, what's happening? And the seller right away said, listen, I had to buy this, but I think that things are going to improve in the next 6 to 12 months. So do I just sit and wait and not sell the business now and wait for things to normalize? And we said, no, we can get that through for you, but you just need to be willing to sit and wait and share in the risks to at least wait 2.5 years to get that money back so that the buyer is comfortable enough to release those funds once things do normalize. And they were willing to share in that structure and give that structure. And that's how we were able to get them an additional $1 million in value simply by extracting this value once things did normalize. Okay. Now, the second scenario, this is a company, it's a consulting company, and they work on large real estate projects. So they provide design and consulting real estate services. And so, because there is in certain project-based situations, certain ARs are paid much slower. So even though they were collecting AR on a 30 to 60 day basis, some of their larger projects required them to hold AR for 120 days, 180 days, sometimes even a full year. And so what ended up happening is this business, which had annual sales of 39, 42, 45 in the last 3 years, their AR has gone up a lot. It's gone from 486 to 550 to $855,000. And so when you kind of calculate the net working capital, so we take AR plus prepaid expenses minus AP and accrued liabilities minus sales taxes, not income taxes, but sales taxes like HST, GST, that sort, and you calculate the net working capital, this is the bolded numbers over here. And then this is what I always do whenever I do like a quick math on a balance sheet. I take the net working capital, divide it by the annual sales, and get a percentage. And so here was 4.2, 7.7, 15.5%. So right away, even when we were talking to them as a prospect, I said, okay, well, hold on a second. Your balance sheet's getting fatter. You're putting more cash into your balance sheet. Can you help us understand why? And they talked right away about some of their larger clients and how they had to sit on it. And the primary driver of this fatness on their balance sheet was the accounts receivable line. And so we really zeroed in and spent time to understand, okay, what is required working capital for this business? And so when we sold this business, we actually sold the business and said, no, let's not look at it as an average of the last 12 months of balance sheets. Well, what essentially you're focused on is you don't want to cut another check to put money into the business to support the business. And so in most instances, they're collecting money between 90 to 120 days. So you just need the next 3 to 4 months of operating expenses to be covered by the current net working capital of the business. So what we essentially did is, okay, you're paying based off of this 4.5 million in annual sales, and based on that, FY kind of 2021, 2022 figure, the annual OPEX, the operating expenses for the business was $1.794 million. And we divided that by 12, multiplied it by 3, and multiplied it by 4. And we got a range of essentially, for the next 3 to 4 months, your operating expenses to maintain this level of the business that you're paying for is about $400,000 to $598,000. So really, the business has $700,000 net working capital. You don't need all $700,000. You really need about $400,000 to $598,000. So this excess of $100,000 to $251,000, that's considered extra AR that can be carved out and should be the seller's once collected. And so the way we structured this deal is we essentially said, hey, listen, that extra 200, and we set the hold back at about 250,000. So the 250,000 is held back for 12 months. As the AR is collected, so it's not paid out, on bullet, based on month 12. It's simply allowing for that deferral of payment as the AR gets collected, because they're long dated AR and it takes time to collect. Once the AR comes in, it gets applied against the holdback and reduces the outstanding level. And whatever doesn't get collected because of bad debts or whatever happens, the buyer doesn't risk potentially paying for bad AR. They're essentially only paying for whatever actually is collectible above that threshold. And so that's the way we structured, and we were able to get an extra $250,000 for this client, because we're able to justify that you don't really need the current amount. There was excess net working capital on the books that was accounted for in their overall valuation for the business. Okay, so now mistake number 5. So we talked about in mistake number 4, cash-free, debt-free closes. I would say in 95% of our transactions, it's cash-free, debt-free. Majority of the time it is, because, most net working capital, you can collect on this AR in most instances 30 to 45 days. There's a lot coming in. Your outflows are not as high as your inflows. So, you can cover, your operating expenses fairly easily. But there are certain instances where you actually have to post cash, put it up front to allow that business to be transitioned. And so there are a few situations where we see cash-free, debt-free closings become more tricky, and you actually have to leave cash behind, because the implications from a private valuation, from a company valuation perspective, is that now, yes, you're going to get $5 million for your business, but then you're going to have to leave behind via a purchase price adjustment $400,000 in cash up front to cover off the net working capital for that business. Okay, and so there are 3 instances where we see this most frequently. The first is the company has no cash but has an operating line that funds the working capital cycle. And the telling sign is that it's always drawn. So if you look at the last 3-4 years, and they're always drawn on their operating line, it's just kind of fluctuating up down as they collect funds and put funds against the operating line, but they're never in a positive cash balance. They always have an operating line drawn. In this scenario, I would say in most instances, there is almost a working capital deficit that needs to be accounted for, because the reality is they're running on this treadmill, constantly collecting funds to apply against the op line, but they can never catch up to pay out their operating line. So really, the operating line is almost seen as a true net working capital cost that is part of the balance sheet. And so to true up the balance sheet, to kind of right size it, what ends up happening is that you have to pay out the operating line and zero it out. And so that typically results in a large purchase price adjustment downwards that the seller usually doesn't account for when they think about simply their EBITDA multiple. Okay. The second one is the company has excess cash, doesn't have an operating line, but the cash is essentially the operating line because it's fluctuating up and down. So it's almost the exact same thing. So the difference is that you've drawn cash out in the first scenario. In the second scenario, you have a lot of excess cash. You don't know what to do with it, so you just hold on to it. And instead of drawing on an operating line, you just use your extra equity to finance the working capital cycle. Now, in this scenario, the question is what level of cash should be left behind to continue to cover those working capital needs? Because if the cash is jumping up and down, up and down, up and down, there is a true working capital cost there. So some level of cash needs to be left behind, but not all of it. And so that you need to analyze that. And then the third scenario, and this is probably the most common that you'll see where cash gets posted and left behind, is in high growth scenarios. So a company is growing very quickly, or they're projected to grow very quickly, in a hockey stick scenario, or they're a technology company. They have a lot of operating expenses, and so their inflows are not covering their outflows in the interim. Whether that's because they're ramping up or they've just added fixed costs. And so in the next 3 to 4 months, the rule of thumb is always, I try to say the next 3 to 4 months, which is kind of like a quarter cycle of costs, if the business is not able to cover using their own non-cash working capital, the operating expenses of that business, then you need to put some cash up front to help finance that deficit. And so we'll go through an example of that as well. So let's look at first the working capital deficit scenario, where it's scenario number one, essentially no cash and then an operating line that's always drawn. So in this instance, this company was a distribution business. They were always kind of on that treadmill running, so they never really had excess cash, and their operating line, you can see over in this line, was drawn. And so as they were growing in sales 7, 6, 9, 1, 10, 3, their operating line was ramping up as well. And as a percentage of sales, their op line was actually ramping up from 6% of sales to 11% of sales. So essentially, they've been using their operating line to fund their growth. That's what's happened here. And the challenge with this business as well, which is relevant for some people, is sometimes some sellers will post their building for the bank as additional security to allow the bank to lend more. But the reality is a new buyers may not have that property to post as security, so they may not have the same level of access to the operating line financing as they did in this situation, because on net working capital of 1.7, they were able to borrow 1.2 against that 1.7, which is highly levered for a working capital loan, but that's because the seller had the building as additional security. So this is a very common situation that I see, and this is what I would call a working capital deficit type balance sheet. They simply drew a lot. They used bank financing to finance that growth rather than the owner putting money in, because what the owner was doing was stripping money out via salaries and excess money that, again, is being adjusted for on the EBITDA side. So they did get a good EBITDA valuation, but on the balance sheet side, he didn't leave enough money on the balance sheet to actually fund the business. And so there was a deficit scenario here. So just at a high level, I always ask, and this is the way you should think about it, understand kind of the parameters, the purchasing parameters and the AR parameters. So here, inventory, kind of would be ordered and bought on a 150-day cycle. So I'd say every half year there'd be a big investment in inventory. And that's why, even though they were getting funds coming in via AR, they had to put money up front to finance that inventory. And then AR would get paid on a 60 to 90 day basis. So overall, you could go almost, 3/4 of a year and sell inventory, finance that inventory, and then sell it and only collect it, almost probably like 210 days later. So the working capital cash conversion cycle of this business was also very extended. And not only that, but they also had to hold back 10% for up to 2 years. So overall, from a cash conversion cycle basis, this was not a strong business in that regard. And that's why, the seller kind of got into this situation where they had this operating line. But, to right size this, the seller had to pay out this operating line of 1.2, deliver a cash-free, debt-free deal still, because once they were able to pay out the operating line, the inflows were able to cover the outflows, and there wasn't going to be any interim deficit where they had to put up more excess cash. They simply just needed to pay out the operating line. And so you can see the deal terms over here. It was a 1.1 million EBITDA business. The buyer paid out 4.5 times valuation, and then the seller, via purchase price adjustment, settled that 1.2 million outstanding debt. So the net proceeds to the seller was actually 375 instead of 49 on that, original valuation because of this adjustment. And this was another thing that we talked about up front with the seller. They were a little hesitant at first. They didn't believe us, but after kind of getting educated from their accountant and everyone, they realized that they were in a balance sheet deficit situation. And I've seen it on the other side where I've been on the buy side. We've been talking to a seller about, hey, this is going to be a cash-free, debt-free close. Like, you need to pay out that op line. It's like, no, that's required. You're assuming that. And it's like, no, we're not. Like, we are not assuming that. That is yours to pay out. And it's sometimes, especially if these larger op lines that are drawn down for these balance sheet heavy businesses, it can eat into your purchase price. Like that's a 20% reduction in the total value of the business because of the deficit. Okay. Now, here's another situation. So this is scenario number 3, where it's a high growth situation. And so this maybe get a little complicated, but this is an advanced video, so bear with me here. So we talked about this in part 1 already. This is a company that we talked about. It's a service-based business. They had secured contracts. These were concrete numbers that they were working off of, highly reputable past customers that they worked with. That historically this business was doing kind of in the high ones, 300,000 EBITDA. All the customers came at them, booked all these contracts. It was going to jump to 5.8 with $1 million in EBITDA. So a significant ramp up. Okay. So we were able to prove, and so just assume that this is justifiable because it was, there was contracts in place. But now let's look at the other side. So the way that deal got structured, and you can go to part 1, is that, the seller took a cash down deal plus a sizable earn out to share in the risk so that the buyer would pay them full value for that $1 million in future EBITDA, but it would be based on earnings in the future via an earn out. But when you look at the balance sheet side and the net working capital side, it's almost the opposite discussion. So they did get an upfront value, but they also had to leave cash behind to support this ramp up in net working capital. So this is a perfect example of where we talked part 1, they're going to get this deal on the EBITDA multiple side, but then on the flip side, there was almost a separate negotiation that we had to go through for about a month where we analyzed the net working capital of the business and said, hey, I'll pay you this 5 times for this business, but I'm also going to need some cash left behind because this business is going to quickly run out of money and we're going to actually run into a deficit. And so the way we figured that out is we took a monthly sources and uses projection table. And so just very simply here. So, based on the 1.5 in sales and current sales at the low level, that's probably about 125,000 in sales as of today. This is kind of the normal sales level. They had about 325,000 in AR today on the books based on this current level of performance. But in the next month, the contract was going to hit and they were going to start delivering on a significantly higher earnings. So you can see from a monthly sales perspective, it was going to ramp up 375, 390, 420, 520,000. So significantly different in the next 6 months, that sales was going to ramp up. So it's almost a hockey stick, okay? Again, this was supported by contracts. And because there was contracts and production schedules in place to allow for this not production schedules, but, delivery service timelines in place, they could actually semi-accurately project these monthly numbers. So we worked very hard with the seller to get these numbers in place and then really figure out the type of cost structure required to deliver. So you have to bring in consultants, add some more permanent hires. So that cash outflow, they made that investment very early on. And so that's the challenge with high growth businesses. Typically the costs come first before you can deliver on the sales because you need the people there to deliver on the sales. So you can see here that the ramp up in OpEx, 375, 312, 390, 393, and it continued. We assumed that, that OpEx was going to ramp up by month 2, even though the ramp up in sales is going to happen by month 6. So costs were ramping up faster than sales, which resulted in negative, net profit for the business for the first 4 months. And so, really just, to delve a little bit more, essentially what we did here is we said, what's the inflow of cash? What's the outflow of operating expenses? So operating expenses would be, payroll, advertising, vehicle expenses, whatever the case is. And so, you could project that in a concrete basis. On the inflow side, there was an assumption that this business would invoice their customer once a month at the end of the month. They'd wait about 5, 10, 15 days after to wait for the billings to come in. And they'd send out that invoice to the customer, and the customer would take another 45 days. So realistically, it's probably invoicing time of 10 to 15 days, another 45 days for collection. So it'd take probably 60 days from month end when you deliver the sales to when you actually collected the money. So really, you look at this and you say monthly sales 375. They invoice the next month and they collect the next month. So you can follow the numbers diagonally here. Follow the numbers this way, right? And so you can see that if month 1 I sold 375,000, I billed it at 375, and I would collect those AR in month 3 only. And so based on that, we knew what our OpEx was. We knew what our collections would look like in terms of when AR and cash would actually come in, because it's not about invoicing AR, it's about when that AR is actually calculated. And so if you were to change the collection days, this would change completely. But we negotiated and we figured out what's kind of like a reasonable collections period. And so when we actually mapped out AR generated, what would be collected based on outstanding AR in past months and the outflows, you can see in the first 4 months, there was a deficit. There was a net negative cash flow because the business was ramping up as it was growing into these larger contracts. And so the sum of those 4 months of negative costs was $276,000. And so the buyer immediately said, listen, I'll pay a 5 times multiple on the future earnings, but then you're also expecting me to cut another check to finance this interim deficit. I can't do that. And so what ended up happening in this deal is we posted cash to cover the interim deficit, but got full value on the ramp up. And that's a very good example of how you would negotiate a high growth situation. And this was not a cash-free, debt-free deal because of that reason. Okay. So mistake number 6, now we're going to go more into the book value versus enterprise value. And so when a buyer multiplies the annual EBITDA of a business by a valuation multiple, they're calculating the enterprise value, which is everything included, the balance sheet, normal level of working capital, and the value of that cash flow. But sellers sometimes confuse the value of their cash flow with the value of their balance sheet. And so I always point this out because sometimes people say, hold on a second, I just made a recent investment into equipment. I just bought a $1 million piece of equipment last year. Even though the full value and the savings of that equipment are not being reflected in my cost, I'd like to get my multiple enterprise value, so $1 million times 5, plus recoup some of the value of that equipment. But from a buyer's perspective, the key question is, why would I pay for that equipment when it's essentially the equipment that's generating the profit that I'm already paying you for? It's almost as I'm double paying you. So in most instances, buyers will not pay for the book value of recent investments in CapEx plus the enterprise value, because that's almost seen as double dipping. I'm already paying for the value of the cash flow that that equipment's generating. So, that equipment is being assumed as part of the enterprise value. And so sellers need to be aware. Now that raises an interesting question. What if all the equipment is probably worth more than the enterprise value on a multiple basis. And so that does happen in certain situations where, asset heavy balance sheets and companies where they have a significant amount of equipment, probably if you just liquidate the equipment or price it off of book value, you could get more than the EBITDA multiple. And so, when you're thinking about asset heavy businesses, sometimes enterprise value is not the right pricing approach. Okay, so let's look at a real life example. So this company, they're a manufacturing business, and so it was a really nice business. We were able to get a deal done, but it took a little bit of kind of working, because what ended up happening is that the seller kind of said, "Hey, listen, I want to make an investment to grow the business," but they quickly had some personal events that resulted in them wanting to sell the business as well, right? So last year, they invested $2 million, doubled the size and capacity of the production capacity, and they were really able to set the business up for growth. And so they were saying, listen, based on this $2 million investment, I could get this business to $10 million in sales and 1.6 in EBITDA. But today, last year when I spent this $2 million, I'm only doing 577,000 in EBITDA. So it's a very different business. So obviously the seller who needed to sell in the situation, how do you kind of recoup the $2 million that you invested into the equipment in addition to getting the enterprise value of the business? No buyer would cut you a check and say, I'll give you $2 million for the equipment that you just bought, and then as well the enterprise value, because they would be overpaying for the current cash flow that they're getting. So there had to be a deal structured here where they actually priced the deal at the current levels of earnings. So they took an EBITDA multiple of 5 on the 577,000. They got about 2.6 up front, and then they did a profit share where they said, if I believe that you've expanded the capacity, you've done the great thing to set the business up for growth, and if you grow into that, I will share some of that future profit based on performance targets, but I can't pay for that up front. And so that's really how you would structure a deal where you can kind of get some of that extra balance sheet value, recent balance sheet value that maybe is not reflected in the earnings. But say, for example, you bought equipment from 5 years ago for $4 million. That equipment's already been reflected in the profit of that business that's being generated today. So it only works where you can get extra value if you just recently, in the last maybe year or 18 months, invested in something, and the full synergies and production capability of that investment has not been reflected in the earnings. But if you've made investments 5-10 years ago in equipment and you still think you can recoup that $10 million, unfortunately you can't, unless you just simply sell the book value and you don't get enterprise value. You don't sell it off of a multiple basis. And so that's what scenario 2 is. So in this example, we were working with a specialized industrial manufacturer. They had invested probably about $10 million in the last 5 years. So they were highly wealthy individuals, came from a wealthy family. And so, they really liked the business that they were in. They owned it for 40 years, had a lot of extra cash, but really the business was a little sleepy. They were actually only doing about 900,000 in EBITDA, even though they made a $10 million investment in production, in their production equipment. So the reality is when you kind of priced and you did an equipment appraisal for the business, the equipment appraisal alone for the equipment, you could, if you just shut down the business, sold it at auction, was 4.6. So, the question is, how do you sell this business? Do you sell it off of a multiple and maybe sell it 900,000 times a multiple of 4 or 5? Or do you just sell the assets of the business and get whatever you can for the goodwill? And that's what we did. So in this example, the balance sheet, so we had 4.6 in equipment. There's about 700,000 in net working capital. And then we found a buyer that was able to cut a check for $250,000. Not a lot, but $250,000 for the goodwill of the brand, the website, the customer list, and some of the employees that were assumed as part of the sale. But just by simply doing that, it was 4.6 plus 700,000 plus 250,000. That was a $5.5 million deal. Whereas, if you were to price it only off of EBITDA, you couldn't get the extra balance sheet value, because buyers would simply say, well, no, I'm paying the EBITDA multiple. I'm not going to pay for the balance sheet. And you probably would have gone a 4 or 5 times multiple on that. So maybe 3.6 to 4.5 instead of 5.5. So, in this scenario, it made more sense simply to market the business as an asset sale rather than an EBITDA multiple sale. Okay? And so the last mistake that we're going to be talking about is probably a very common one in kind of the 2021, 2022 marketplace, where rental rates are increasing significantly. Inflation is persistent, interest rates are going up, and a lot of commercial landlords are increasing their rents. And so the market average rental rate, if you were to go to market now, has almost doubled in certain areas. I know in Toronto, commercial real estate rents have been a huge problem when trying to sell a business because the market rents have changed so dramatically in the last, 2-3 years. But, when you're going to sell a business, it's really, really important to understand the impact of market rent and factoring that into your business valuation. And sometimes owners are like, well, I own the property. I have no interest in selling the property. I just want to sell the business, but it doesn't matter. Anytime you think about selling the business, the property is intertwined with the business. And you have to think about them as two separate transactions. Even though you're not going to sell the property, if that's not your intention to, you still need to get an accurate appraisal or at least valuation done by a commercial realtor to understand what the value and the market rental rate for that property is if you were to sell it. Because you take that information and then you incorporate it into the business valuation. And so something that I've seen now recently is that people are getting a little bit more lax with the market rents. Either they're saying, well, whatever I'm paying, whatever the business has been paying historically because I own the property. And this mistake isn't relevant if you don't own the property. If you're leasing it from a third-party landlord, there's no issue there. But if you're selling a business and you own the underlying property, and say, for example, you've been paying below market rent in the past, and you're very lax and saying, you know what, I'll just continue, I'm accepting of selling the business and, the buyer continuing to pay this below market rent, that there's a big problem there because you're actually leaving a lot of money on the table from a valuation perspective and not doing yourself a good service. And then on the flip side is, maybe the business owner wants the market rent, but they don't understand the implications of adjusting that when it comes to normalizing the historical EBITDA and lowering the business value. So really, in terms of this mistake, I just want to caution people to say, in this marketplace, it's really important to factor that in. So whenever you're getting a CBV done, with evaluation with a CBV, or you're spending time valuing your own company, actually do research on the real estate side of the transaction as well, because it's not just a business sale. The two are highly intertwined. And so one of the most common questions I get nowadays from sellers is, well, hold on a second. If I raise my rent by $1, I'm getting $1 more in rent in my real estate company, but then I'm lowering the dollar of profit in my business because I'm paying $1 more in rent. So isn't it just moving money from one side to the other? And in a way it is from a dollars and cents perspective, but from a net value perspective, it's actually significant impact. And so this is the last example I want to talk to you about. And so I've just kind of distilled, past client that we had this discussion with into this scenario. So, the client had a 54,000 square foot facility, kind of the cap rate on their property was about 5%, and the valuation for their business was about a 5x multiple, okay? And so the important thing to realize is that even though the dollar shifts from one side to the other, from the RealCo to the OpCo, or from the OpCo to the RealCo, the valuation multiple between a business sale and a real estate sale are significantly different. And I would say 99% of the time, you will get a better value for that dollar if it goes into the real estate company, i.e. you charge yourself appropriate market rent. Because here's an example. That 54,000 square foot facility, they were charging below market rent at about $10 a square foot. The business itself, pre any rent adjustment, was generating about adjusted EBITDA of $1 million. So really, $10 times 54,000 square feet was about 540,000 square feet in rent paid, and that was baked into this EBITDA. So this EBITDA is after 540,000 in rent, they were doing about $1 million in adjusted EBITDA. So if you were just to look at the left-hand side and price this business and say, pay 5x on EBITDA and then pay a 5 cap on 540, you get $5 million for the business, $10.8 million for the property on 540,000 in NOI. Just let's use some rough numbers, okay? Now, if you were to make the adjustment, because market rent for this property was actually $15 a square foot, not $10 a square foot. So on 54,000 square feet, if you adjust it to $15 a square foot, market rent, the rent paid to the RealCo increases from 540 to 810. Naturally, the EBITDA goes down by the exact amount, right? So the increase in the rent reduces the adjusted EBITDA. So now you price EBITDA 5x times 730, and then you price 810 using a 5% cap rate, and boom, the combined value is actually significantly higher here. And again, the reason why is that cap rate, it's almost an equivalent 20 times EBITDA valuation. So unless you were to get a 20 times multiple on your business's profit, it almost always makes sense to move the EBITDA to move that dollar into the realco instead of the opco, because you're leaving significant money on the table in the grand scheme of things. Even though you don't want to sell that property today, God forbid something happens to you tomorrow, you want to have the flexibility of making sure that you didn't lock yourself into a devalued property. You price the business correctly so that it reflects true market value. And anyways, most buyers, if they, certain situations where I've even seen sellers say, you know what, I know what I'm doing. We warn them of the risk and they're like, no, I'm okay because I'm going to adjust it 5 years down the line. Buyers know that. And they're going to say, you know what, listen, I'm going to pay a lower valuation, knowing that even though, yeah, I'm paying below market rent for the next 5 years, I'm still going to get whacked when that rent adjustment comes 5 years down the line. So I'm going to factor that in anyways right now. So, trying to sneak away with, inflating the EBITDA of the business by lowering the market rent, it just doesn't make sense. It always makes sense to price it correctly so you can get maximum value for both of your assets whenever you want to sell both of them. So this is the part 2 video. Hopefully you found it really helpful. This one's a little bit more advanced than part 1, but if you have any questions, you want to reach out and talk about net working capital, I know it's always a pressing concern for business owners, and I'd be happy to talk to you about it. But there's a lot of different ways you can negotiate net working capital. I've shown you some examples, and there's a lot of excess value there that sometimes just people forget to account for or negotiate for, and that's why it's really important to hire an advisor, an M&A advisor or an investment banker, because we know what we're doing. We've seen a lot of these examples already, and we have a demonstrated track record to extract that value from the balance sheet. Because when you are pricing a private business, it's not just the EBITDA multiple. The balance sheet has a big impact on valuation, and you can't forget it. So hopefully you liked the video. If you found it helpful, please like and subscribe to the channel for more. And please reach out if you have any questions via LinkedIn, through the website at Robley Capital, or through my Finance Kid Gmail account. So hopefully you guys found the video helpful, and take care. Thanks.